The banks are starting to lay off staff. Yes, you heard it right. Layoffs have finally come to the banks. There was a time when bank jobs were prestigious, stable, and well-paid. But times have changed. As the backbone of various industries, banks are inevitably affected by the broader economic environment. Now the banking sector has become highly competitive. I was chatting with some friends from the bank recently, and they said that all outsourced employees in their unit are to be let go by June this year. Either their contracts won't be renewed, or they'll be forced to leave through various employee evaluations. Many have already left. This wave of layoffs in the banking sector reflects the current severe economic situation. The banks are planning to cut salaries again. Did you all know that? 20 years ago, when I had graduated from college, getting a job at a bank was something everyone envied. Bank jobs were glamorous, offered great benefits, good pay, and high social status. Getting in wasn't easy. It required either a high level of education or connections. I've heard stories of people spending hundreds of thousands just to secure a position at a bank. But nowadays, bank employees have to work long hours, starting early and finishing late, and their income is hardly what it used to be. Recently, the banks are not only planning to cut salaries, but also lay off staff. One major reason for this is the real estate market. Banks used to make significant profits from loans to real estate companies and individual mortgage loans. However, in recent years, the real estate market has been in a slump, with fewer real estate companies and individuals taking out loans. At the same time, residents have been very keen on saving money, pushing our nation's savings to a record high. For banks, deposits are liabilities and loans are assets. With liabilities increasing and assets decreasing, banks are struggling to balance their accounts. So these salary cuts and layoffs are inevitable results. China's economy is in a downturn, with financial risks continuously rising, and the banking sector is experiencing a significant impact. Along with layoffs and salary cuts, a wave of bank closures is hitting the country. According to official data from the Chinese Communist Party, 1,257 banking branches have exited the market in the first 5 months of 2024, a 30% year-on-year increase. Reports from Chinese media indicate that a large portion of the exiting branches are rural commercial banks and rural credit institutions. Specifically, 527 rural commercial bank branches have exited, accounting for 42%, and 266 rural credit cooperatives and their branches have exited, making up 21%. The number of exiting branches from state-owned banks are 227, joint stock banks at 94, city commercial banks 82, and village banks 34. Additionally, 16 foreign bank branches, 6 policy bank branches, and 5 rural cooperative bank branches have exited the market. At the same time, the number of newly established banking institutions is decreasing. In the first 5 months of this year, only 894 new bank branches were set up. Some people have expressed concern, saying, a wave of bank bankruptcies is coming. Columnist Wang He pointed out that in recent years, the CCP has been working to prevent and resolve risks associated with small and medium-sized banks. Starting a few years ago, the government allocated several hundred billion yuan from local special bonds specifically to supplement the capital of small and medium-sized banks. To mitigate risks, the CCP has been pressuring banking branches to downsize and restructure. Consequently, from January to May this year, a large number of bank branches have been cut, with rural commercial banks and village banks being the primary targets of these reductions. American economist David Huang pointed out that the current state of banks reflects the broader issues facing China's economy. First, the CCP previously focused heavily on policies favoring the development of the internet and chip technology, leading to the hollowing out of the real economy. This situation was further exacerbated by missteps such as the dynamic zero-COVID policy and trade wars, deepening the economic downturn. Second, the banks themselves have high debt ratios and low profitability, making it difficult for them to bear such large personal expenses. In addition to the exit of bank institutions from the market, bad debts and banks are also on the rise. A report by The Economist on March 27 stated that hundreds of banks in China are experiencing soaring bad debts, which have become a ticking time bomb with potentially unimaginable consequences if it explodes. On March 19th, Zhejiang Bank released a performance forecast stating that its net profit for 2023 is expected to decrease by no less than 30% year-on-year. According to data from the Chinese company app Enterprise Alert Service, as of the end of September last year, Zhejiang Bank's non-performing loan balance stood at 6.9 billion yuan, with a non-performing loan ratio of 2.3% and a provision coverage ratio of 134%. The Economist reported that Zhejiang Bank has unusually informed investors that, due to poor loan performance, its profit for 2023 could decrease by 30%. This is information that banks in mainland China typically avoid disclosing. In fact, these banks often go to great lengths to keep such information from being revealed. The CCP has been using bank loans to asset management companies, AMCs, as a way to manage its non-performing loan issues. The contracts between the banks and AMCs include certain clauses that allow the asset management companies to avoid the credit risks associated with the non-performing loans they purchase. Confidentiality clauses ensure that these arrangements are not disclosed, sometimes even withholding this information from the courts. While banks involved in such transactions appear to be addressing the bad debt problem, they are, in reality, concealing the extent of their bad debt issues. The report states that Professor Ben Chaoran Wong and Assistant Professor Ruan Tian Yue from the Finance Department at the National University of Singapore Business School, along with Associate Professor Miao Meng from the School of Finance at Renmin University of China, have warned that these problematic loans will continue to accumulate over time. For hundreds of banks in China, they are like a ticking time bomb. In fact, Zhejiang Bank's bad debts have increased sevenfold from 2015 to the end of last year. In December of last year, China CITIC Bank was fined 220 million yuan for poor management of bad debts, while the Agricultural Bank of China was penalized 27 million yuan for similar violations. The report indicates that the increase in non-performing loans is weakening the balance sheets of financial institutions, which in turn will make it more challenging for the Chinese government to provide direct financial support to healthier institutions. China's mainland banks are facing severe bad debt issues. According to data from the China Financial Regulatory Administration on May 31st, the non-performing loan (NPL) ratio of commercial banks stood at 1.6% at the end of the first quarter, remaining roughly unchanged from the previous quarter. The balance of non-performing loans reached 3.4 trillion yuan, an increase of 141 billion yuan from the end of the previous quarter. Official data shows that in 2023, the outstanding non-performing loans of China's commercial banks climbed to a record high of 3.23 trillion yuan. Previously, the Henan Village Bank's incident occurred, involving the life savings of 400,000 depositors, totaling 40 billion yuan, which they were unable to withdraw. The depositors' efforts to defend their rights were violently suppressed by the CCP. Chinese-American economist Li Hongqing stated that there are over 4,000 small and medium-sized banks in China similar to the Henan Village banks. He warned that these banks will soon be impacted, and incidents like the one involving Henan Village banks will continue to emerge. Recently, several of China's largest state-owned banks have started issuing a special type of loss-absorbing bond for the first time in an effort to avoid a crisis similar to the 2008 Lehman Brothers collapse. On May 20th, the Industrial and Commercial Bank of China announced the issuance of 40 billion yuan worth of total loss absorbing capacity, TLAC, bonds. On May 23rd, the Bank of China also began pricing for the issuance of 30 billion yuan and TLAC bonds. Total loss absorbing capacity, TLAC bonds, are designed to address the issue of banks being too big to fail. In 2015, the Financial Stability Board introduced TLAC capital requirements for global systemically important banks to prevent the potential systemic financial crises that could result from the failure of these large banks. U.S. investment advisor Mike Sun noted that while issuing bonds can be a short-term measure to cope with crises, long-term solutions rely on boosting domestic demand. He emphasized that the current measures by authorities merely delay the crisis without addressing the fundamental problems that could lead to its outbreak. As the banking sector in mainland China faces a downturn, layoffs and salary cuts are becoming increasingly common. Chinese media reports that layoffs and salary cuts have become the bank's practical choices for staying afloat. The report states that the Industrial Commercial Bank of China, ICBC, had the largest scale of layoffs last year, with over 8,000 employees leaving in 2023. Since 2016, ICBC has been continuously reducing its workforce and the number of its branches. The number of employees has decreased from a peak of over 460,000 to less than 420,000 in 2023, a reduction of 42,500 over 7 years, averaging about 6,000 layoffs per year. The number of branches has also been cut from 17,000 in 2016 to 16,000 in 2023, a reduction of over 900 branches. Chinese media reports that for bank employees, the situation is even more dire, as not only are salary increases unlikely, but performance bonuses already received might also be reclaimed. For example, China Merchants Bank's annual report shows that during the reporting period, the bank reclaimed performance bonuses from 4,415 employees, totaling 43 million yuan. Similarly, the Bank of China reclaimed bonuses from 2,059 employees, amounting to 23 million yuan. According to a report by the paper, in mid-May, Zhao Jia, a customer manager at a local bank in Western China, received her monthly salary, which, after deducting the mandatory social insurance and housing fund contributions, was less than 1,000 yuan. Previously, her monthly salary exceeded 10,000 yuan. A banker based in Guangzhou stated, "In the past few days, nearly all employees in the industry have experienced salary cuts. Currently, the ratio of actual wages to the supposed wages is around 60%. STCN, a news portal under the Securities Times, reported that managers at several banks, including China Merchants Bank, CITIC Bank, Zeshang Bank, and China Minsheng Bank, have seen salary reductions of over 60%. The most dangerous factor that could trigger a financial crisis in China is the real estate sector. The property market has been sluggish for 2 years, prompting various measures across the country to restore the consumer confidence in home buying and reduce the number of unfinished housing projects. By early May, 24 cities in China had completely lifted home purchase restrictions, and 35 cities had relaxed them. On May 17th, the Chinese government announced a provision of 300 billion yuan in loans to support local state-owned enterprises in purchasing inventory for affordable housing. Additionally, the People's Bank of China lowered the down payment ratio for first-time home buyers to 15% and for second homes to 25%, while also removing the lower limit on housing loan interest rates. However, Tianlei Huang, a research fellow on Chinese economic issues at the Peterson Institute for International Economics, believes that the effectiveness of these measures is limited. He argues that when mortgage rates decrease, while savings rates remain relatively high, it will lead to profitability challenges. Furthermore, even if the official rescue measures help clear local housing inventory, if these homes remain unoccupied, they will eventually turn into bad debt. At the same time, new home prices in Chinese cities continue to decline. According to data from the National Bureau of Statistics of China, in April this year, the sales prices of new commercial residential buildings and second-hand residential properties in 70 large and medium-sized cities fell by 0.6% and 0.9% month-on-month, respectively. These declines widened by 0.3 and 0.4 percentage points, marking the largest month-on-month drops in recent years. Something even scarier than the drop in second-hand housing prices. New homes in Chengdu can't hold out anymore. You've probably seen posts about certain developments in the southern part of the city blowing up your social media feeds these past few days. The sight of people queuing in the middle of the night is reminiscent of the housing market 5 or 6 years ago. Many areas are now engaging in price wars, lowering prices if sales targets aren't met. Areas like Yixin Lake, Xinjiang Ecological Belt, and Tiandong Tianfu Front Bay are getting cheaper and cheaper, with some places slashing prices by as much as 1 million yuan. Indeed, price cuts are the most direct way to boost consumption. Moreover, new homes not only boast better quality, but many are also mid-rise slab-type apartments and townhouses, complete with 3 major interior upgrades. If you're currently looking at second-hand homes, I strongly suggest keeping an eye on the new housing market. If you could buy a new home in the same area and at the same time, definitely go for the new one. In Chengzhou, 85% of properties have seen significant drops in value. The house prices in the high-speed rail northern New City area have plummeted, falling below their initial purchase prices. In the Luyue Lake area, newer neighborhoods are losing so much value that even the down payments are gone. In the high-tech zone, properties have been halved in value before even being handed over. The market prices are becoming increasingly chaotic. According to the latest report from China Real Estate Information Corporation, the Chinese real estate market continued to operate at a low level in the first 4 months of this year, with the sales volume of the top 100 real estate companies dropping by 46.8% year-on-year. Bloomberg reported that the Bloomberg Intelligence China Developers Index fell by 3.2% on June 6, extending a decline of about 20% since its peak in mid-May. Sunac China Holdings dropped by as much as 11%, and Shimao Group Holdings fell by 8.3%. The report indicates that real estate stocks have been declining due to skepticism about the support plan introduced by the Chinese central government on May 17th. Initially, investors were encouraged by policies such as reducing the down payment requirements for homebuyers. However, doubts soon emerged about the effectiveness of these measures in revitalizing demand and addressing the excess housing inventory. At the same time, Fitch Ratings has downgraded its forecast for the value of new home sales in 2024, predicting a decline of 15% to 20%. This is due to the lower than expected sales trends in the first 4 months of this year and downward pressure on new home prices. Recently, the top 3 companies in China's real estate industry by sales, Poly Real Estate, Vanke, and China Overseas Land and Investment, reported their performance. The sales for these state-owned enterprises' real estate companies have all dropped by more than 30%. Reuters previously reported that S&P Global stated the measures introduced by the Chinese government in mid-May might temporarily boost demand for real estate. However, the increased leverage could lead to defaults on housing loans, posing risks to banks operating in second and third-tier cities. S&P Global has indicated that housing prices in third-tier cities are expected to decline by about 14% between 2024 and 2025. This could potentially lead to homebuyers facing negative equity, where the balance of their mortgage exceeds the value of their homes. Some homeowners might ultimately default on their loans and stop making payments. In addition to declining sales performance, the supply and demand for commercial housing continue to shrink. According to data from the National Bureau of Statistics of China, from January to April, the sales area of newly built commercial housing was 293 million square meters, a year-on-year decrease of 20%. Among these, the sales area of residential buildings dropped by 24%. The sales value of newly built commercial housing was 2.8 trillion yuan, down 28.3%, with residential sales value declining by 31.1%. However, over the past 2 years, the inventory of unsold commercial housing has continued to grow. As of the end of April, the inventory of unsold commercial housing was 746 million square meters, a year-on-year increase of 15.7%, with the inventory of unsold residential buildings growing by 24.5%. According to Caixin, the inventory of unsold commercial housing nationwide has significantly increased since 2022. At the end of February 2022, the inventory was 570 million square meters. By April this year, it has risen to 746 million square meters. Over the past few years, the monthly inventory of unsold commercial housing has fluctuated between 400 million and 700 million square meters. In addition, Chinese real estate companies are facing considerable debt repayment pressure. According to statistics from the China Index Academy, the scale of bonds maturing for real estate companies in 2024 is 770 billion yuan. Associate Professor Sun Guoshang from Nanhu University in Taiwan believes that China's real estate crisis could spread to the financial and bond markets. Poor real estate sales could impact the entire financial sector, including related industries within the banking sector. He argues that all these problems ultimately stem from the inherent issues within the Chinese Communist Party's system.